Welcome to Stocks in Translation, Yahoo Finance's latest podcast that helps you cut through the noise, the hyperbole to make sense of this market and to help you make the best decisions for your portfolio. I'm Alexandra Canal, in for Jared Blickery, and today I'm joined as always by the one and only Sydnee Fried, along with Matthew Luzzetti. He is a chief U.S. economist at Deutsche Bank. Thank you so much for joining us.
Thanks for having me. It's great to be here.
Again, it's going to be a really fun episode because we're talking about the Fed. All eyes are on the Fed as the central bank is poised to cut interest rates, but at the same time, they are dealing with a weak jobs market and more concerns that a soft landing may not be achieved. And that brings us to our word of the day, which is rate cuts. Everyone talks about them, but what exactly would a cut do when it comes to the U.S. economy? And this episode is also brought to you by the number 25. That is the number of basis points the market expects will be slashed from the current Fed funds target rate, bringing the new rate down to a range between 5.0% and 5.25%. So let's get into all of it, Matthew. I mean, we still have that inflation print due later this week, but based on what we've gotten so far, all the data, where is the U.S. economy at right now? Are you bullish or are you starting to turn a little bearish?
No, I think we're overall constructive. You have a labor market that is cooling. We got further confirmation of that on Friday. As you look at that data, clearly the number of jobs that are being added on a monthly basis has continued to decelerate. We got about 140,000 jobs added in August. That was a bounce back from the July data. At the same time, you do see the unemployment rates rising. So we're up to 4.2%. That's almost a percentage point above its low not too long ago. But I think it's important to kind of dig into the details of what's going on. What you see is a labor market where there's no layoffs essentially taking place, very low. But labor supply and a lot of people coming into the labor market is driving a loosening of the labor market and the unemployment rate higher. I think that leaves us kind of constructive on the consumer. I think that you continue to see this resilient growth outlook, but also does point to some downside risks that the Fed is contemplating in their rate decisions.
So given that, and given the rate decision that's upcoming, are you in the camp of 25 basis points or 50?
We're still 25. Coming into Friday's jobs report, we had expected the Fed to cut rates 25 basis points in September. We did think a lot hinged on that jobs report, though. If you got confirmation of the weakness in July or even a weaker outcome in the August data, we thought that the Fed could shift to a 50 basis point rate cut. But I think the labor report was good enough to keep the Fed at 25 basis points. And we got some confirmation of that from the Fed speakers on Friday. We heard from New York Fed President John Williams. We heard from Fed Governor Chris Waller. Both of them suggested that there's not a lot of urgency in terms of cutting rates. They're certainly going to be cutting rates, but probably not at the larger increments that some were contemplating.
Matt, what's the unemployment rate that would concern you at this point?
So usually it's the rate of change that gets people concerned. So there's something called the SOM rule, which looks at the three-month average in the unemployment rate relative to its 12-month average. And anytime that increases by 0.5 percentage points, we've had a recession historically. In the July jobs report, that got triggered, meaning we saw the unemployment rate rise by more than 0.5%. So the change is always important. I think if you look historically, a 4.2% unemployment rate is actually fantastic. It's still quite low from a historical perspective. If you look at the U.S. economy relative to most other economies, we have a low unemployment rate. So it's not the absolute level that concerns you. It's typically the rate of change, in part because the unemployment rate usually doesn't just grind higher very slowly over time. If it rises sharply around recessions. And so that's kind of the concern that you look at.
And there's been so much talk about the unemployment rate, but there really are so many numbers within this report. One thing that stood out to me was hourly wages. They did tick up month over month. And to me, that stuck out because we've seen inflation easing. So how important is something like that? And what other metrics is the Fed really looking at when they're trying to make these decisions?
Yeah, that I think was a good part of the jobs report. You saw average hourly earnings were stronger than expected. We back out an implied rate for income growth. And it's essentially taking how many jobs there are, how long are people working, and then how much are they making per hour. And that's up 5% year on year. So the jobs report is telling you people actually have pretty reasonable and solid income at the moment. And I think that's a reason that you'd want to be constructive about the U.S. economy. Two other things I would highlight are really solid. If you look at the prime age labor force participation rate, so those people that are between 25 and 54 age group, it's near record high levels in terms of those people's participation in the labor market. The same is for the employment to population ratio for these people. So the prime age group is doing quite well at the moment. Outside of that, I think the Fed is very focused on not only the unemployment rate, but what is making up the unemployment rate. So is it being driven higher because of layoffs or not? I think what we got a confirmation in August is that it's not about layoffs. It's mostly about people coming into the workforce, which is driving the unemployment rate higher at the moment.
And talk to us about another part of the labor report, which is the revisions. How critical is that revised number from the prior month, and what does it kind of tell us about how the labor market has actually kind of been this whole year? And, we maybe had a bit weaker numbers than we thought month to month.
Yeah, it is important. When you look at the data, we had about 80,000 downward revisions to the prior 2 months. This is a normal revision that we get every month to the past 2 months. And that tends to be cyclical, meaning as the labor market is strengthening, you tend to get upward revisions. As the labor market's weakening, you tend to get downward revisions. So I think it is confirmation of a softening trend in the labor market data. Again, I don't think it's bad enough or weak enough to make you think that recession is the most likely outcome, but it's certainly confirmation that the labor market is weakening. And if I were to highlight one thing that was concerning in the jobs report, it would be that. I think if you had gotten 142,000 jobs and you had gotten a 4.2% unemployment rate and strong average hourly earnings, it would have been, I think, more clear-cut that the Fed would cut rates by 25 basis points or 0.25%. The downward revisions create some uncertainty.
Are we seeing more significant revisions lately? Has this always been a trend? And I'm trying to think post-COVID, is it more difficult to get it right the first time?
I think it is more difficult when you look at the response rates for the advanced surveys. It is lower than it's been historically. So that is creating some uncertainty. In terms of the month-to-month revisions, they're not all that larger than what we've seen historically. If we could get very wonky, a few weeks ago we got the QCEW data.
QCEW, what's that?
It's the quarterly survey that helps to inform revisions to the employment data.
Wow.
And so you may have seen headlines that there was an 800,000 downward revision to the jobs report. That's what drove that revision. And that's large from a historical perspective.
Turning back to the potential rate cut that we're likely to see in September, kind of what's the difference between 25 basis points and 50 basis points in reality?
Sure. So, the way that we think about it from a market perspective is that the market is already pricing in rate cuts to a certain extent. They're pricing in a little bit more than 25 basis points for the next meeting, and then a sequence of somewhat larger cuts as you look beyond that. Now, that means that a lot of the rate cuts are already reflected in mortgage rates or 10-year Treasury yields or the stock market or corporate credit spreads. And we often think that you need to kind of surprise relative to that to impact things. But it does mean that should be reflected in credit card rates. It should become reflected into auto loans. If the Fed cuts more than what is expected, that'll mean lower credit card interest rates, lower auto loans, mortgage rates will come down as a result of that. So that's the way in which the Fed, by changing rates at the overnight rates for banks, gets percolated out the curve and into the real economy.
But will that be an immediate change? We always talk about the long and variable lags within monetary policy. So when can we see that relief when you talk about credit card loans, when you talk about mortgage rates? Is that something we'll see, reflected in a few months after the Fed cuts rates? Is it an immediate change? How do you look at that? And when can consumers and American workers really feel that?
Yeah, I think a lot of it is already becoming reflected. We've seen mortgage rates come down pretty substantially as the market has been betting on the Fed cutting rates more. So I think that happens, somewhat instantaneously. That's been some change for the Fed in recent years, where they've been providing, I think, more forward guidance about how they're thinking about both the rate hiking cycle previously and rate cutting cycle now. And in part, I think that is kind of shortening the long and variable lags. It means that they're communicating to the market up front, the market's pricing that in a little bit earlier, and it gets reflected in the interest rates that people care about earlier.
And that's a change, right? Because it wasn't always that we had these updates from Powell getting on the stand, really providing that commentary for the market. So that's something that you would say was probably a recent change that's impacting.
If you go back to the mid-1990s or the early 1990s, the Fed would not even tell you what the new interest rate was that they had just set. And at that point, they started having a statement that was released. They used to tell you what the target rate was. And then over time, the Fed has just very clearly moved and shifted towards more transparency, greater guidance. Chair Powell gives a press conference after every meeting at this point in time. The Fed releases their own forecasts on a quarterly basis. We'll get an update of that next week. So this is a clear shift, not just for the Fed, but global central banks towards greater transparency.
I'm genuinely confused. I feel like markets would have gone crazy, right, if you didn't kind of know what was going to happen. I feel like now we sort of know what happens every time. Like, was that the case back then? People just didn't know what was going to happen and like Wall Street was just shocked and the Dow fell 800 points.
I think it's more a question of when does that adjustment take place.
Right.
It will take a place at some point, but previously, without more Fed forward guidance, without more guidance about what they would do at each meeting, it would happen around the meeting rather than before the meeting. So as you saw kind of on Friday, there was big market adjustments that were taking place, big responses, both as we got the data for the jobs report and then as Fed speakers came out, John Williams and Chris Waller, trying to guide the market or provide some thought into transparency into how the Fed's reaction function was. We saw the market switching between pricing 25 or 50 basis points pretty aggressively over the morning.
Yeah, well, there's so much more to get into here, Matt, but we're going to take a quick break. When we return, we dig in a little deeper when it comes to the Fed's next path forward for interest rates and how that could be changing very soon. Stick with us. Matthew, you just told us that 25 basis points, that's your base case when it comes to September. I've been hearing a lot of commentary from Fed officials that the pace of cuts matters more than the actual amount. Do you agree with that thesis? Does 25, 50, does it not really matter as long as we're seeing consistent rate cuts over time?
Yeah, I think the Fed's view, which I would agree with, is it's not just about do they go 25 or 50 in September. It's really what do they tell us about this overall cutting cycle? Where are they expecting rates to be in 3, 6, 12 months? That is what I think is most important for households. It will determine how low mortgage rates get, how much credit card interest rates and auto loans come down. Is what matters most for markets. I know that there is
high-yield savings accounts too,
high-yield savings
right?
accounts. I know there's always so much focus on the next decision. It will be 25 or 50 basis points, and it does make a certain amount of sense. I think the Fed is telling you something and signaling something by whether or not they go by 25 or 50 basis points. But if you take a step back, what will be most impactful to the economy, for households and markets over time, it will not just be what they did in September, 25 versus 50 basis points, but the amount of reductions that they had over the course of the next 6 to 12 months.
I have a question. If we do get 50 this month, does that signal that the economy is in a lot more trouble than we thought it was?
I think that's always the concern, right? So if the Fed surprises markets in what would be a dovish direction by cutting more than is anticipated, there's always concerns that that could have a negative signaling or confidence effect or channel, that it tells markets and households, oh, maybe there's something wrong with the economy that they need to be responding to. I don't think that would be the reason that they'd be cutting by larger amounts, but it's something that they need to consider when they're making the decision about going 25 or 50 basis points. Ultimately, this is where having press conferences helps because they would be able to release that decision, and not very long after, 30 minutes later, Chair Powell will be able to communicate about why they made that decision. So I would expect if they did cut by a larger amount, by 0.5 percentage points, we would come out and Chair Powell would have signals that this is mostly about insuring against downside risks to the economy, insuring against the labor market softening more than expected, and that they believe that they're pretty restrictive. And so they can dial back that restriction by a decent amount more quickly than they previously thought, and still keep the economy kind of right on track.
We'll have the Fed dot plot projections out in September as well. So we will get a more of a clear look at what Fed officials are thinking. But how far and how fast do you think the Fed will go when it comes to cutting rates when we look over the long term?
Yeah. So we've been, I guess we were a little bit more dovish early on, expecting the Fed would go by 25 basis points at each meeting to start. But we've had this view that they wouldn't go all that far. Relative to what the market and the Fed thought. So there's this thing, kind of the neutral Fed funds rate. It's the level of the Fed funds rate that things would level out to overall. That kind of keeps everything in balance, would keep inflation at target, would keep the economy on track, labor market where it needs to be. We think that that's probably in the 3.5 to 3.75% range. And that's eventually where we expect the Fed funds rate to get.
So question, when they were raising rates, I do feel like it was, I don't know what exactly was, but let's call it like 50, 25, 25, 25, and it was a build like that until it was held. Is it not supposed to be like, oh, just drop 25 every time? Like, how do they decide to pause for 1 month versus, you know what I mean? Like, how is it like, oh, I'm going to cut 3 meetings in a row, but 4th meeting, nah, we'll hold it. Like, how do they decide something like that?
Yeah. So during the hiking cycle, you had 75 basis point hikes as well.
Oh, wow.
And I think what guided that, the way that you could view that hiking cycle was they started at 25, they then expanded to 50s, did 475s, and then slowed it down. And their thought process was they were starting at 0 rates, and they felt like they needed to get rates up pretty quickly to a more normalized level. So they had to move in larger increments. There's a somewhat similar debate or discussion happening today. So we are sitting at a 5.3% Fed funds rate. We are reasonably above where we think rates eventually need to be. So why don't they start off a little bit larger and then slow the pace as they come down? I think ultimately the way that they make those decisions, a lot of it is data dependence. How are they viewing the data? Not only the baseline or modal outcome, but the risk distribution about that. If they were to cut by larger amounts today, I think it's more about that risk story. And it's about the fact that inflation has come down. They're less worried about upside risk to inflation, and they are more worried about downside risk to the labor market.
So let's talk about inflation, because that's something that's coming up. And we have seen inflation moderating. However, there are some very sticky areas of inflation: shelter, core services. How does the Fed thread that needle when it comes to lowering interest rates while also continuing to battle those sticky areas of inflation that they really haven't been able to get a handle on?
Yeah, I think it's one area where we have the benefit of new data available to us after the pandemic, which we didn't have before. So I think if you had the current environment right now where shelter inflation, rent inflation in particular, just looks very high, the Fed would be more hawkish than they are today. I think one reason that they're not is because they have all this evidence from private sector estimates of rental price inflation, which has come down substantially. And we've shown, their own research has shown that that's a very good leading indicator for where rental price inflation, the CPI, is eventually going to go. So I think the Fed has a view, and we would agree with it, that you've seen disinflation across a lot of categories. One remaining item is rental price inflation, which looks sticky, but that should come down over the next 6 to 12 months. And the reason is we've seen it already reflected in the private sector estimates of rent.
Mm-hmm. So the Fed's goal is to bring inflation down to 2%. That's the target. Is that a realistic target? Should that be changed?
Why is it the target, too?
And yes, it feels random in a sense. Is it, though, or should that be the goal?
Yeah, so I think there's nothing magical about 2%. I think the way that we would tend to think about it is 0% inflation or deflation is a bad outcome for the U.S. economy. We've seen that historically. And at the same time, if the higher the inflation rate is, 2% or higher inflation expectations, it gives the Fed more scope to cut rates and provide accommodation to the economy. And so we've ended up with 2% as being the accepted outcome, but there's nothing kind of magical about that 2% number. Is that achievable? I think it would just be notable that we're now having a debate whether or not we could get inflation to 2 from above. We were having the exact opposite debate in 2018 and 2019, where inflation was stuck below 2%, and the Fed wanted to actually get inflation higher.
For people who don't get it, why can't you just have 0% inflation?
Yeah. So the reason is, I think everybody would want to have very high wage growth and very low inflation. The problem is those two things go together.
That's true.
So
we want to get paid at the end of the day.
Everyone wants to get paid. We want wage growth to be high and inflation to be low, but you can't have both, essentially. What we found and what you see is if inflation is low, interest rates can't move up. Now maybe that's a good thing, but the Fed also can't respond to shocks to the downside. And what we found before is it meant that they got stuck at 0 interest rates, and that's a bad outcome for the economy because the Fed can't dig us out of holes that we've seen. So there could be some benefits of going from 1.5% to 2%, as an example. Now, we've also learned that going to 3, 4, 5, 6, 7%, obviously that is not an outcome the Fed is looking for. So they would like to get much closer to 2% as we look ahead. Is that achievable? I think we have pretty good confidence that they can get within a pretty close range to that. If you look over the past 3 months, core PC is 1.7%. Annualized over the past year, it's 2.6%. So by next year, we expect it's going to be below 2.5%, getting closer to at least 2.25%.
For people who don't really understand, I don't feel intuitively that I understand what the difference is between the federal funds rate and interest rates. Can you speak to that a little bit?
Sure. So the federal funds rate is the rate at which banks lend to each other overnight. And the Fed determines that by setting other short-term interest rates. And really the distinction between that and everything else that we typically talk about and care about is that everything else is determined by the market. So the Fed funds rate is something that the Fed sets at the front end of the curve, and then everything else that we essentially care about, whether it's the 2-year yield or 10-year yield or credit card interest rates or auto loans or the 30-year mortgage, that is a market-determined outcome, which is based on what the Fed sets the Fed funds rate in. So that's kind of the baseline or benchmark that helps to determine the constellation of other interest rates in the economy.
And when the Fed funds is at 0, what does that mean?
Well, That only happens if we are in a bad outcome for the economy. So we've had high unemployment, we've had low inflation. Essentially only happened twice. It happened around the global financial crisis when the Fed responded to that. It then again happened to the pandemic. What it means is the Fed, different from other central banks, has decided that they will not cut rates into negative territory. We had seen the Bank of Japan, the European Central Bank had chosen to do that. The Fed did not do that. And so it means that they are kind of constrained in how much additional support they can provide to the economy if they are stuck at what's called the zero lower bound for interest rates.
All right, Matthew, now I'm going to have you take the floor to a segment we like to call Who or Better. And I want to talk this week about the Fed's dual mandate, which is two areas that the Fed has been consistently focused on, achieving both price stability while also having maximum sustainable employment. How successful do you think the Fed has been in navigating that? And even though we might not have all the information yet, is there one area of the economy that's winning or on the path of achieving that goal for the Fed?
Yeah, in terms of how successful they've been, I would say that they've been far more successful than I thought they were going to be.
At bringing down inflation.
Bringing down inflation without having more negative outcomes for the economy. Right. If you go back and look historically, for as high as inflation got, there's very little precedent for a central bank being able to bring inflation back down to target without a recession. We've had that happen so far, and that's a fantastic outcome for the economy. If you look at 2023, growth was 3%. Inflation came down substantially. The unemployment rate remained below 4%. So that was a fantastic outcome. They've navigated this, I think, incredibly well. And so that I think is really important. In terms of which part of the dual mandate is winning out at the moment, the past 3 years have been all about inflation.
Right.
Inflation, I am more confident that is coming back down to target. So it can be winning in that perspective. But in terms of what the focus is increasingly, it's on the labor market. And it's about whether or not this rise in the unemployment rate is entirely benign or not, or whether or not it could accelerate and give us worse outcomes. Again, our baseline is that it won't, that we don't get a recession, that we have a soft landing, but that is the risk that the Fed's worried about right now.
Right, and not to end on a negative note here, but we did recently speak with Michael Darda from Roth Capital Partners, and he does think that a recession could be coming and that we may be operating on a bit of a lag. So I know your base case is that we will achieve a soft landing. Are there any cracks in the economy that you're seeing right now that make you a little nervous that perhaps a recession could be coming 6 months from now, a year from now? Are you confident that we're in a solid place?
Yeah, I think it's important for some context. So, the typical probability of a recession a year ahead is 15 to 20%. That risk is always kind of out there as you look historically. But I think what we also know is it typically takes shocks. It's not something that just happens without a shock taking place. What you look for are kind of preconditions that make the economy more susceptible to those shocks or not. I would say we don't really have those preconditions. You don't have imbalances in the economy. The housing market is not out of balance. We haven't had overbuilding or overspending. Debt service ratios are pretty low. Financial conditions are easy. Credit lending conditions have come in. So all that, I think, is very much consistent with getting a soft landing, even though you're seeing this slowing in the labor market. If there's one area that you'd be concerned about, it is that hiring for firms is very low. And it means that the strong labor market increasingly relies on a low layoff rate. And so if layoffs were to pick up, that would be the thing that you'd be worried about tipping us into recession. I just don't see the reason for layoffs to pick up at this point in time. So I think that's the good reason to have a soft landing as your base case.
All right. I like it. We're ending on some positive news. Matthew Luzzetti, thank you so much. We could keep talking for hours about this, but that does it for today's episode of Stocks in Translation. But make sure to check out some of our other episodes. You can find it where you get all of your favorite podcasts on our website, along with YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. That's all for now. Keep it tuned to Yahoo Finance.